So, Christopher, we just heard from Mike Wilson about the mismatch he sees between what expectations are for earnings currently and what the reality is likely to be. What kind of picture are you looking at in the year ahead?
I think he's absolutely right to get us to draw our attention, to pivot our attention from worries about inflation, worries about where yields will top out, to looking at the earnings picture, which is likely to be a little more challenging this year, next year, excuse me. It's not yet 2023, but next year than it has been this year, because the forces of rising costs, rising interest rates will begin to really bite. And I think all of the things we've heard from companies in the last couple of earnings seasons, where they have been warning us about tougher times ahead, even as they've been reporting good numbers through the course of 2022, I think they are properly telling us to set our expectations for something lower going into next year as the global economy slows down.
The drawdown this year has been significant. We're looking at an S&P down almost 20%. And if you look at next year's expectations, they're also pretty bleak, with some people expecting a decline in the S&P 500. Do you think that this is going to be the first time in the last 2 decades, really, we're going to see a double down year?
I think it's hard to see next year being a down year, because we expect, the economy will slow, but it shouldn't be too long or too deep a recession if we get to that. What I think happened this year, of course, was not so much in terms of change in earnings growth forecasts, but it was a real re-rating of the market to a lower PE level, because there was uncertainty about inflation, about where yields would top out. Now we've kind of all mostly agreed that we understand, rates are going to continue to rise. It's unlikely that inflation is going to get away from the Fed. And so we've got a range within which to work, and it's much easier to sort of put a number, a multiple on next year's earnings, even if it's going to be harder to forecast those earnings themselves.
Okay, so Christopher, if you don't think inflation is going to get away from the Fed, could the market get away from the Fed if it is looking forward at potentially a brighter future than what we're currently living today, and financial conditions don't tighten to the extent that the Fed would like to see?
Well, I think that is the real question. And when I say inflation get away from the Fed, I just don't think we're not going to see CPI rising from here. I do think as we see, continued disruptions in supply chains, a hot jobs market, a very strong consumer so far, it's going to be a slow decline in inflation between now and the end of the year. We're thinking around 3.5% at the end of December of 2023. The market is pricing in much lower than that. So it is going to be something of a tug of war between the market and the Fed, and the Fed's rhetoric is going to continue to be hawkish, and that's why we've seen, I think, some of that price action today and since the trading days, since the press conference last week.
What are the big risks to the CPI story here, and what if it just does not come down as fast as anyone would like?
Well, I think we're all focused on the price of shelter, the price of energy, and the prices of services. Those are the things that in the CPI calculation continue to be relatively high. Shelter, it's generally reported with a little bit of a lag, so it will remain higher for a little bit longer. But it should be coming down, because we've seen what the higher mortgage rates have done to the price of housing around the country, and that should feed through to lower rents as well. Energy, that's really anybody's guess, and you've talked about that. The reopening of China may have an impact on that. Sanctions against Russia may have an impact on that. The EU gas cap may have an impact on that. But that's something that we're going to watch. I think the big thing that the Fed is going to be looking for is a cooler jobs market in the U.S., because that really is what drives the services inflation that has been continuing to be hotter for longer right now. And so they'll be looking at wages, job openings, quit rates, that sort of thing.
Christopher, you mentioned China, which is a story that has shifted so incredibly dramatically over a series of just really a couple weeks, from COVID zero to an absence of COVID containment whatsoever. How are you thinking about the risks surrounding the China story, in that, in theory, it could be a boost to global growth, but that also could mean greater commodities demand that exacerbates the inflation problem?
Well, I think it's a lesson in humility to all of us that we really have a clear picture of what's going on in China. It's been very difficult to travel there. It's been very difficult to understand exactly what's behind the government's policies or its pronouncements. We're in touch with our colleagues who are based there, and even they, I think, are having a harder time piecing together what the picture looks like for 2023. What I think is clear is that China is reopening, that growth next year will be higher than it is this year. It's the only major economy where growth is accelerating around the world, so that's important. But we need to make sure that it opens at a pace that is sustainable, that doesn't overwhelm the healthcare system, that doesn't start roiling, getting setbacks or temporary lockdowns in certain regions that would start roiling supply chains again. And we also don't want it to be too fast, which will put a lot more pressure on commodities prices if demand for LNG, natural gas, oil, and other commodities really picks up in China. So, the market, I think, is right now forecasting around 5% growth in China next year. That feels a little high to us, but something between the 3.5% this year and 4.5% next year would be, that Goldilocks scenario for China's reopening for the rest of the world.
Really less than 2 weeks left of the year. To the extent that you make those last-minute changes to clean up the portfolio heading into this next year, what do you do?
Well, I think there's really very little you do between now and the end of the year, and we all have to admit that this January 1st to December 31st is an artificial construct. If you're investing, you really need to be thinking, months and years ahead of time. We're looking for a year next year that should be, better on the market side of things. Even if the economy is slowing down, people will start seeing through into 2024 by the time we get to summer. The Fed hikes should have stopped. We think the Fed may keep things isn't going to start loosening until 2024. But, once we get to the summer, we think that, people will start looking ahead and seeing a recovery in view.